Hi everyone, welcome to this topic explainer video for the Strategic Business Reporting exam. Today we are going to discuss conceptual framework. I'm your SBR expert tutor Aleena Kareem. We are going to go through the main areas which are related to the conceptual framework as it is a very comprehensive topic. So I'm not going to go into complete detail in this limited time, but I'm going to touch upon the main areas which are very important from your exam point of view. And also we are going to discuss certain examples in which we can see that practically the framework is being applied on the individual standards also. So let's start with the conceptual framework. The complete conceptual framework is broken down into 8 different parts, and these are called the chapters of conceptual framework. Let's see them one by one. So the chapter number 1 is the objective of general purpose financial reporting. In a short while, we'll see what is actually the purpose of financial reporting. Then we will see the qualitative characteristics of useful financial information. This is a very important area from your exam point of view also. Then we are going to touch upon financial statements and the reporting entity. This is more of a theory type of thing, so I will not go into a lot of detail regarding this point. Then we are going to touch upon the elements of financial statements which form the base of financial statements of companies all across the world. Then we are going to talk about the recognition and derecognition criteria. Then measurement criteria, something which is very frequently mixed up, recognition and measurement. Presentation and disclosure, and concepts of capital and capital maintenance. Chapter 7 and Chapter 8, I will refer you to Study Hub to study that. However, the remaining parts we are going to cover in this particular video. So let's first of all start with the purpose. Why do we even have the conceptual framework? Please keep this in mind that conceptual framework it is not a standard. It is a guidance which is available for the standards. Why? Because wherever users are facing any problem in preparation of financial statements, they need to have a proper base through which they can refer and identify how they can account for different items. Also, whenever we are talking about consistency, so we have multiple standards and we need to have accounting treatments which are consistent across different accounting standards. So framework ensures that this is covered all across standards. And also it is very focused on the needs of the decision makers who are ultimately going to use this information. So when we come to the purpose over here, it says that the purpose of having a conceptual framework for financial reporting is that first of all, IFRS accounting standards are based on it and they need to be consistent across the standards. When there is no standard related to a particular item, then also it helps us identify what is the correct accounting treatment. Or maybe a standard does exist on a particular item, but we are not very sure how we are going to do the accounting treatment of one part of it. In that case, also we have to identify, like very recently, examiner has repeatedly discussed cryptocurrency. So we saw that there is no specific standard which is available on cryptocurrency. So by identifying the features of cryptocurrency, we identify what is the most relevant standard and what is the most relevant accounting treatment that can be done. Same is the case over here for any other item that comes. Then it is used for the understanding and interpreting of standards also. Because of its consistent nature, it helps in understanding for anyone who has a basic knowledge of accounting all across standards what they are talking about. Then, when we talk about the objective of general purpose financial statements, please keep this in mind that the whole reporting, it is focused on the people who are going to use this reporting. So these are very focused on the primary users of the information as well as the stakeholders. So when we talk about primary users and stakeholders, they are not just the owners. They might be the lenders of the company. They might be the suppliers, customers, government. Anyone can be a relevant party. But over here, we are focused on the users, which are the primary users of financial statements. And what are they looking for? They are looking for the amount, timing, and uncertainty of future net cash flows, If we talk about assets, the definition of assets in itself fulfills this first criteria, which says that we are going to talk about the net cash flows which are going to come in the business. Then we can apply the same definition on the outflows also. So in case of liabilities, we have to identify what is the amount, what is the timing of the outflow of liabilities. Because you know that if the amount and timing is certain, then we can recognize the assets and liabilities. However, if uncertainty comes in, the criteria completely changes. And this is something which is applicable through IAS 37. So IAS 37 tells us that when it is probable that a payment is going to be made, we recognize it as a provision. However, if there is an asset which is probable that it is going to be received, we do not recognize it till the time it is virtually certain. So these are the criteria which have been set as a basic benchmark, and now any particular standard can use these. Also, it talks about the management's stewardship about the economic resources. So it helps users to understand how well the company is performing and how well the people who have been given the duty as stewards to run the company, which is the directors of the company, how well the executive management is actually handling it. Now, the next very important area of framework that I want to focus upon is the qualitative characteristics of financial information. Always remember when you are telling the qualities of, let's suppose, a person. So if you're saying that a person is very honest, he or she is very generous, all of that. So you are trying to signify that this person is a good person. So over here also, when we tell the qualities of financial information, the purpose is that ultimately we are trying to tell that these financial statements are good financial statements. And what financial statements are good financial statements? The ones that are useful for the users. So for me, a financial information is good quality if it is fulfilling the need for information that I require from it. So the same criteria is applicable through the conceptual framework also. Please do remember this is an area in which you have to remember the exact terms as well, because these are the terms written in the framework, so you have to follow them. So starting off with, the qualitative characteristics are distributed into two chunks. One chunk is called fundamental qualitative characteristics. The name in itself shows that there should be no compromise on these items. So these are fundamental for the financial information to be useful. And then when we have gone through the fundamental qualitative characteristics, then we come to enhancing qualitative characteristics. Enhancing in itself means which further improves. So it makes the information further useful, right? So over here, when we talk about the fundamental qualitative characteristics, there are two fundamental qualitative characteristics. One, relevance, the other, faithful representation. Without the presence of these two qualities, the information is not useful for us. Now, what do we mean by the relevance and faithful representation? So relevance is something which is relevant to the decision-making needs of the users. This can be through their predictive nature about the future or a confirmatory nature in which something is being confirmed from the past. Also, it is very important that materiality is seen. So materiality, as per the conceptual framework, comes under the relevance criteria. But what is the purpose of it? That every information that is material, that should be shown in the financial statements. We have multiple examples of this. A very good example of it is IAS 10, when we are talking about events after reporting period. So the non-adjusting events in IAS 10, technically they are happening after reporting date. Their conditions did not exist at the reporting date. Still, the standard says that if the non-adjusting events are material, then you need to disclose them in the financial statements. So you cannot pass their double entry because they did not happen during the year, but still you have to show them separately as disclosures. Another very good example of it is when we talk about IAS 8. So IAS 8 says that if there is a major error that you need to correct, then you need to incorporate it not just in the current year. If it was affecting the previous years, you go back, you adjust the previous year financial statements also. So this is something which tells us that if any item is material, which is it is important for the decision-making needs of the users, they are incorporated and the conceptual framework is guiding us about it. Then we come to faithful representation. Again, the term itself, faithful representation, is showing that the financial statements should show what is actually happening in the business. And how can that be achieved? Only if the information is neutral, which means that the information is free of any kind of bias. It is free of any kind of error, and it is complete also. So no transaction has been missed out in it, right? So touching upon these topics one by one, when we talk about free of bias, a very good example of it is that whenever we apply the prudence concept, so prudence is very commonly discussed in IAS 2. So IAS 2 says that you have to be prudent, which means that your assets should not be overstated and your liabilities should not be understated. So if the NRV of an item, the net realizable value of an item of inventory, becomes lesser than the cost, you need to recognize the loss immediately. However, if you are foreseeing a profit, you're going to wait till the time you earn that profit and then you recognize it. Now, over here, the company needs to be very clear about it, very neutral, free of any kind of bias, and not trying to overstate their assets by recognizing a future profit, or maybe not recognizing a loss that has been incurred. Same is the case with result to impairment also. In IAS 36 as well, the standard says that whenever there is an indicator of impairment, we need to recognize the amount in our financial statements. We need to immediately test for impairment. And then if the carrying value is less than the recoverable value, then we need to recognize the impairment also. So one part over here is that it should be free from any kind of bias. Then the information should be complete. All information related to a particular transaction should be correctly recognized, right? Like we see in IAS 16. IAS 16 says that whenever you are purchasing an asset, you need to identify and recognize all the directly attributable expenses in the cost of the asset. Now, someone can say that, okay, how about I recognize it as an expense? Ultimately, also it is going to be depreciated. But then you are not presenting the information correctly. So it needs to be complete, it needs to be neutral, and the last thing is it should be free of any error. Which brings me to the point that I just discussed, that IAS 8 guides us about any kind of error that we have identified in our financial statements. And it says that as soon as you have identified the error, immediately correct it. Even if it happened in the prior years, go back, correct the financial statements of the comparative years, and so that your balances in the current years become correct. So these are the fundamental qualitative characteristics which make the financial statements information useful. Now we come to the enhancing qualitative characteristics. So once the information has been through the fundamental qualitative characteristics, they come in enhancing qualitative characteristics. So these are comparability, verifiability, timeliness, and understandability. Let's pick them up one by one. So if we are talking about comparability, comparability says that your information should be comparable, it should be consistent with your own past accounts also, and with similar companies in the industry as well. So when you have to ensure comparability, it is about consistency of applying your policies of, let's suppose, the accounting policies that you are using for a particular item. So let's suppose we are using FIFO for inventory. So the standard says that if you're using FIFO, please keep on using FIFO till the time you decide to change the accounting policies to, let's suppose, AFCO. And in that case as well, you need to go back and apply the change retrospectively. So whenever there is a change in accounting policy, you have to apply it retrospectively. Why? Because we have to ensure comparability. Then we come to the next part, which is related to verifiability. Now, in case of verifiability, it says that the information should be credible and reliable. So different people who are looking at some information, they should reach the same conclusion regarding it. So whenever we are presenting the information, this is precisely why we need to provide detailed disclosures also, so that any kind of accounting treatment which has been performed, a reasonable basis for it has also been provided. Then when we talk about timeliness, so in case of timeliness, it says that the information should reach the users in time to help them make decision making, or to help them make decisions effectively. So once again, this is very important, because if let's suppose there is an investment which is coming up. So the company is issuing shares and they want people to invest in the company. And the performance for that current year, which is the profitability for that current year, is being disclosed later, then it is not a timely information. So timely information should be provided so that the users can have an effective decision making. And lastly, it is about understandability. So understandability says that information is clear and concise. So it is presented in a way that it is easier for the users to understand it. Something as basic as where standard tells us about the classification of the income to be recognized in profit or loss part, or the other comprehensive income part, that is also related to understandability. So like I-16 says that revaluation gain should go in other comprehensive income. We can create a logic for it where we can understand that we are talking about a gain which has not yet been realized and how it is going to follow a certain. So for every item, it is very important that all of these characteristics are met. Similarly, if I take another example from I-16, it says that at every year end, you have to review your estimate of depreciation by seeing the useful life and the residual value of the asset. So once again, it is important that if there is any change, it is communicated in a way that it is understood by the users. So these are the fundamental and enhancing qualitative characteristics, very important, and you should be able to link them to the transactions which are happening in your exam also and in your organizations as well. Now we come to another very important part, which is called elements of financial statements. Elements are the base of accounting. So whichever business you're talking about, be it like a very teeny tiny business which is operating in, let's suppose, your house lane, or you're talking about the largest of the businesses in the world. For every business, the financial statements are going to consist of 5 elements of accounting. And these elements are your assets, liabilities, income, equity, and expense. So the first 3 items, asset, liability, and equity on the screen, they are related to statement of financial position, whereas income and expense are related to statement of profit or loss. The interesting thing over here is that we are just going to discuss the asset, liability, and equity definitions, because income and expenses definitions are derived from them. And another very interesting part is that for assets, liabilities, and equity, these are the ones which talk about economic benefits. And income and expenses are the items which talk about the change in economic benefits. So let's pick them up one by one. Now, in case of assets, we have 2 different kinds of assets, but first let's see what is the definition of asset. An asset is a present economic resource controlled by an entity as a result of a past event. So it is very important to see that there are 3 major parts of this definition of asset. So it is a present economic resource controlled by an entity, and arising as a result of a past event. So economic resource also shows any kind of inflow of economic benefits. Now, this definition is applicable everywhere where we are talking about the recognition of assets in our financial statements. So whether we are talking about IS 16, where we are recognizing property, plant, and equipment, or we are talking about financial assets which fall under IFRS 9, the asset is going to be recognized. But two other very interesting examples of it in which it seems like the asset can possibly be recognized, but it is not recognized are, number one, when we talk about IS 38. So over here, when we are talking about IS 38, you know that in case of research and development, the standard says that you cannot recognize the expenses which are being charged as research. You cannot recognize them as an asset till the time all the criteria for development are met, which means that the asset does become commercially viable, it is feasible for production, etc., etc. So till the time the economic benefits inflow or it does not become an economic resource for your company, you cannot recognize it. Right? Another very interesting example in this comes from deferred tax. So whenever we are talking about IS 12 deferred tax and we talk about deferred tax assets, it says that in case of deferred tax assets, you can only recognize the asset if there is an expectation that in the future there is going to be profitability of the company against which that asset can be adjusted. If there is no probability of the future inflow of economic benefits in the form of the profitability, then you cannot recognize deferred tax as an asset. So it all comes down to it being an economic resource which is being controlled and a past event needs to be there. So that economic resource part is very important. Now, let's come to the next part, which is related to liability. It says that a present obligation of the entity to transfer an economic resource as a result of the past event. Now, once again, we are talking about an economic resource. However, the difference over here is that now we are the ones who have to pay this economic resource. Again, we are talking about, when we're talking about liability, we need to recognize it when it actually becomes payable from our side. So when we have purchased something and the item has come into our control, only then we are going to recognize the liability. Let's suppose we have applied to the bank for the lease of a particular car. Till the time we don't receive that confirmation that we are going to get the car and these are the legalities that we are going to fulfill and we sign the contract, we do not recognize the liability. So again, it is about the outflow of economic benefits or the economic resources that we are talking about, and we need to recognize them when the transaction actually takes place. Then we come to the equity part. Equity is the difference between your assets and liabilities. When we talk about the conceptual framework, it says that equity is the residual interest in the net assets of an entity. So equity, ultimately, it is a residual interest. When you have assets, you subtract the liabilities from them, and the remaining part, which is attributable to owners, that is going to be recognized. Then the residual interest, once again, it is the leftover interest that is there. And remember, it is not something which has been given by there is a difference between the income part and the equity part. So income part basically also relates to assets, liabilities, and there is a part where we tell that it is not linked to equity. So any contribution which is made by the equity shareholders, it is not going to be shown as an income. So then what exactly is the income? Income is either an increase in assets or a decrease in liabilities. Ultimately, this is other than the contributions that have been made by the equity holders. So whenever we are talking about the best case example of income is when we talk about IFRS 15, which is revenue. So in case of revenue, we have to identify that income is going to be received and how either there is a decrease in the liability, or there is, when we are particularly when we are talking about revenue, it is about the increase in assets. So increase in assets can be in the form of trade receivables, it can be in the form of cash also. Then the last part over here is the expenses. So expenses are the decrease in assets or increase in liabilities that result in decrease to equity. And once again, these are not the distributions to the equity shareholders. Now, please keep this in mind that when we are talking about income and expenses, again, expenses is something which can be associated with any part. It can be a decrease in assets, like in IAS 16, it can be depreciation. Under IAS 38, it can be amortization. Under IAS 36, that can be impairment. So these are the expenses which are resulting in a decrease in the value of an asset. On the other hand, there can be an increase in liability also. So for example, you've used electricity in your business. So based on your accruals concept, you recognize the expense and the bill has not yet been received. So you recognize a liability for it. So ultimately, whichever business in the world do you go about, these 5 elements of accounting are going to form the base for the financial statements. Now, coming to the next part, which is related to recognition and derecognition. Now, with respect to recognition and measurement, first thing that I would like to clarify is that recognition means when and how are we going to pass a double entry, or how we are going to recognize an element of accounting. Measurement, on the other hand, talks about at what amount it should be recognized. So there is a difference between the two. So when we talk about the recognition part, in case of recognition, we have to recognize something in the financial statements. The first of all, it needs to meet the definition of the elements that we've just discussed. It needs to be relevant. It needs to have faithful representation. So the qualitative characteristics need to be there. Now, once again, when we talk about recognition, the recognition criteria helps us in a lot of different cases. Like if we talk about any kind of purchase which is happening over a period of time, or let's suppose we are talking about the recognition of revenue. So if we are talking about IFRS 15, there are multiple cases. At times, we are selling 2 different items together, and one is being spread over time. The other one is being given right away. So there are different performance obligations in a contract. So the framework guides us that for every performance obligation, the revenue is only going to be recognized when it becomes eligible to meet the definition of an asset, liability, income, expense, or equity, or it is relevant for the decision-making needs of the users, and it is required for faithful representation. On the other hand, when we talk about derecognition, so any kind of item being recognized is going to come into recognition, whether it is initial recognition or subsequent recognition. So if you're talking about I-16, initial recognition is there under the cost model, then there is revaluation model also. So in that case, again, the values are calculated and recognition is done. Then we talk about derecognition. So this is where the removal is done. Now, in case of removal, removal can be for the asset or it can be for the liability part. Now, in case of assets, when you dispose of an asset, it is derecognized from the financial statements. So if we are selling a non-current asset, we are going to get the money, we are going to calculate our profit or loss, and we are going to derecognize the asset from our financial statements. In the same way, if you're talking about financial assets, we sell our shares, or let's suppose we had an investment and we had a share-based payment. The company was paying it and we have made an investment in the shares. So when we become eligible for them and we ultimately receive them, now we no longer have a receivable. This can be used, in fact, for a simple trade receivable also. So till the time I have a right to receive the money from another receivable, it is going to be shown as my asset. The day the person pays the money, now I no longer have a receivable. So that needs to be derecognized. Similarly, we talk about liabilities also. A very good example in this case can be your convertible loan notes. So as you know, in case of convertible loan notes, there is a probability that the conversion is going to be done into liability or it is going to be done in equity. So whatever way it has been done, once the decision has been done, now you are going to make the payment and the liability is going to be derecognized. So the criteria are same for everyone. Now, please keep this in mind that we are discussing this topic because this is very important from your exam point of view. It is a base for all the standards and it has been a part of the knowledge of financial accounting, financial reporting, and strategic business reporting, all of them. So see how important can that be. Now, over here on this slide, I have included the syllabus reference. Please go through it to make sure that you are covering every point that is required over here. Now, coming towards the end of our discussion, when we talk about measurement, at what value should the calculations be done? So there are two categories of measurement basis, historical and current value. Historical is very straightforward in whichever standard we are using cost model. So be it IS 16, be it IS 40, be it IS 38, in any of those standards, whenever we are using the cost model, basically that's the historic cost model. It does not mean that the item is going to remain at cost. In fact, it means that even if the depreciation is being charged, it is going to be charged on the cost. On the other hand, there are current value measurements also. There are different bases that are mentioned: fair value, value in use, fulfillment value, current cost. Now, we have a whole standard fair value on fair value measurements. So whenever we are talking about IFRS 13, we need to identify the current market trends and then we have to recognize the value accordingly. So same is the case over here, wherever we are using a fair value model, be it IS 40, IFRS 9, financial instruments. So any standard that is going to require a fair value, even your IFRS 5, non-current assets held for sale, in all of these, we need to identify the proper measurement basis and then recognize these statements accordingly. So in case of exam application, please keep this in mind that these topics, they form a base for the whole accounting standards. So all of these standards are developed on the basis of this framework. So anything that you get, any standard that you pick up, from the inventory which you purchase to the non-current assets that we are purchasing, like a very good example of relevance can be, or faithful representation, both can be that in case of IFRS 5, when non-current assets are held for sale, they are separately shown on the face of statement of financial position. So that is so helpful for the users. So they know immediately by looking at the statement that these assets or liabilities are not going to be there in the next year. So you can pick up any standard. A very good example of that can be with respect to when we talk about the valuation, the correct valuation also, that there should not be overstatement or understatement. A very good example of that comes from IFRS 15. So in case of IFRS 15, we know that whenever there are any discounts offered, or whenever there is a variable consideration, the standard says that you need to make an estimate whether that variable consideration is going to be received or not, and then recognize the value accordingly. Now, this is such a major step, and it is different from the previous standard of revenue, because now it is making sure that the companies are not manipulating the financial statements by initially saying, oh, we expected a higher amount, but we had offered a discount and that person availed the discount later on. So if there was an expectation and you had offered a discount on the very first day, you recognize the revenue at an amount which is the net of discount. So same kind of procedures can be applied for any possible scenario. We talk about IS 19. So IS 19 is saying that today you are recognizing an expense that you're going to pay on retirement. Why? Matching concept. So matching is also going to make a base for it. Then a very good example of accounting concepts is the substance over form concept. On one hand, we are saying that, let's suppose if we have a lease. So in case of lease, it is not, the asset is not legally in our name. However, we still have control over it. So we are going to recognize it in our financial statements, the right of use asset. And the same concept we can apply on consolidated financial statements also, because when we say that in consolidation, they are not two separate economic entities. They are not two separate, legal entities, but they are rather one big economic entity. So in all of that, we have the consolidated financial statements also on the basis of substance over form. So like this, you are going to have multiple examples in which whenever you write something about your standards, you are going to pick up the information from the framework and you're going to make a base for it. And this is a very good way of getting extra marks also, where you share the principles behind the accounting treatments. So they are applicable on all possible accounting treatments. In case of exam questions, you have to look at the requirements. You have to see what kind of data extraction you are going to do. Answer, it should be very relevant. Please always keep the answer relevant. If you write extra information, no matter how good or accurate it is not going to get you any separate marks. Always look at the marking scheme if there are any additional marks also available for this. And the conceptual understanding should be there whenever you want to explain a particular accounting treatment. In the end, I would say, please practice, practice, practice. And a very good way of covering these concepts in further detail in terms of text and through practice are the ACCA Study Hub. So in your ACCA Study Hub, when you open the text for strategic business reporting, there is a separate chapter with the name Conceptual Framework. So I would recommend after this video, you go and read that chapter also. You're going to have much more clarity about it then. So do written practice, keep always yourself time managed, actively read the solutions, and always do a lot of practice before going into the final exam. So this is all from my side for you today. I hope you have understood the conceptual framework well, and you will be able to apply it easily in your exam also. Best wishes. Thank you.